It's a great thing to invest for your future. But today, I'm going to tell you when it actually makes sense to stop saving for your retirement. And I'm actually going to walk you through a specific client example so you can see how incredibly impactful it can be when this is done right. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. There's a lot of focus today on how many people are undersaved for retirement and the average 401k balance at certain ages and how many people couldn't come up with $400 if they needed it for an emergency. There's a lot of truth to that. There's a lot of people that are undersaved and underprepared for retirement. But what people don't focus on is there's a lot of other people who are too prepared for retirement. Not that it's necessarily bad to be overprepared for something, but it means continuing to save and invest and sacrifice and defer at the cost of today. That's where things get bad. I'm going to show you a specific example of this today so you can see this and you can see the transformation that happens when you have a good understanding of how long should you save for retirement and at what point does it make sense to stop. So let's go through a client case study to actually illustrate this. Names, of course, have changed as always, but this is Tommy and Linda sample. Now, Tommy and Linda came to me to do some good financial planning. Now, what I immediately noticed is that they were the classic disciplined, save, live frugally, invest, and prepare for the future types. And there's a lot to admire about that. And it's a very noble thing to save and pursue and prepare like they did. But I want to show you something that was off about their planning. Now, number one, Tommy's 54 and Linda's 52. When they came to me, this was how their investments looked. They had done a good job of saving. They had Linda's Roth IRA with $61,000 in it, Linda's IRA with $33,000 in it. Tommy's 401k had $668,000 in it, and his Roth IRA had $43,000. And then on top of that, they had their checking and savings, and they also had $906,000 in a joint trust account. Now, Tommy had previously worked with a couple tech companies where he had some pretty significant stock options that had liquidated, and on top of that, they had been able just to save consistently over the years. On top of that, they had their primary home worth almost $600,000. They had their rental property in Texas, and then they had the mortgage on their home. So this was a snapshot of where they were, and keep in mind, they're relatively young. They're still in their early to mid-50s at this point with a net worth approaching $2.5 million. The next thing we talked about with Tommy and Linda was, what are your goals? What do you want to have happen? So what is the point of the planning that we're going to be doing? Now, Tommy loved his job, so he didn't necessarily want to retire early. He really enjoyed it. It was demanding. There's a lot of hours. It could be stressful at times. But he talked about the fact that he wanted to continue working until age 67. Linda was actually staying home. She was raising the kids. The kids were between age 16 and age 10. I'm going to come back to that in just a bit. But the goal wasn't to retire early. It was, Tommy said, just to work until 67 and be able to enjoy life along the way as we did that. By the time they got to retirement, their goal was to be able to spend $6,000 per month. So after going through an exercise and just itemizing the different things they wanted to be able to spend money on, $6,000 per month is what they wanted to have just for, call it the basics. Then on top of that, they wanted another $15,000 per year to travel. Now, one other expense that we always like to add in was annual healthcare costs. So because they were going to retire after Medicare age, these numbers here were maybe a little bit irrelevant. What we like to look at for clients is what will the pre-Medicare expenses be, and then what will the post-Medicare expenses be? Because they're projected to retire at 67, these pre-Medicare expenses wouldn't actually factor into their plan, but we were assuming $5,000 of out-of-pocket expenses after Medicare in addition to their Part B and Part D premiums. So these were their goals. Now, another goal that they almost dismissed because they almost think of their goals as retirement and save and defer and push things out to then, but they made an offhanded comment where Tommy mentioned that, you know what, one of our biggest things and our biggest values is just family. We love family time, but we're not able to get as much of it as we'd like. I'm working long hours at work. And on top of that, when I do have some free time, we feel like there's not much money left over. And I'll show you in this next page why not. Tommy was maxing out his 401k plan. His 401k plan, he was putting $30,000 per year in. He was getting a 4% employer match on top of that. And then both of them were saving $7,500 per year to Roth IRAs. So when you look at these numbers, this is about 24% of their income, their gross income, that they were saving. So to Tommy's point and Linda's point of, yes, we value family. We want to do stuff as a family. We just sometimes feel like we either don't have the time to do it or we don't have the money to do it because so much of what we have is going to preparing for retirement because we're good, diligent people that, yes, we live below our means, but a good portion of our money is going into saving for retirement. Now, the next thing we looked at was that income. So today, Tommy was earning a healthy income. He had a $190,000 salary. Again, 24% of this was going towards retirement. And then in the future, they have Social Security. Now, because they're on the younger end, they wanted to plan a little bit conservatively. They had concerns about Social Security and should we plan on a full benefit? We've heard things that say if nothing changes, our Social Security benefits might get reduced. So we were cautious and we said, let's just plan on 75% of what you're likely to receive, or what Social Security states you'll receive, I should say, just to make sure we're not over projecting. So Tommy's actual Social Security statement showed more, but we took about a 75% of that amount, so a 25% reduction, and did the same thing with Linda here. You can see because she stayed home with the children, much lower earnings record, so not as much on her Social Security statement, which is why we're going to actually plan on a spousal benefit for her, but these were their income sources in retirement. So what we wanted to do first with Tommy and Linda is essentially project out. Are you on track for these goals? Are you on track to be able to retire at the age of 67, spend what you want to spend on basic expenses, plus travel, plus healthcare, be in a position to pay projected taxes at that time? The first thing that we did, because they were still several years out from this, is we wanted to get a general idea of what are you on track to have in your portfolio balance. So what we did next is we came to this page right here. Now, one thing to note here that's important is we're assuming a growth rate of about 8% per year between now and the time that Tommy retires. So call it 13 years. I say this all the time, but we project one thing, that's not necessarily a guarantee that that's going to happen, but it's a starting point. So because of the investment mix of their portfolio, we said, what if you get 8% for the next 13 years or so before you retire, and then in retirement, maybe project something closer to about 6.5%. Well, here's what that looks like. Here's their portfolio balance, so excluding their home and their rental property. Here's their portfolio balance today. What they have is they have planned savings, so 401k contribution plus Roth IRAs of $7,500 each, for a total planned savings of $4,500,000 this year, and then the employer match in Tommy's 401k. So when we do that every single year, we say, here's where you start, here's what you save, here's what your employer adds, here's your projected portfolio return. We're simply assuming a consistent return each year. It never happens that way. Some years it's double that, some years this is a negative number. But in general, if you're getting this rate of return, this is the general trajectory of your portfolio balance over time. So this is the first thing we looked at. We said, Tommy, Linda, here's your portfolio balance projected at the end of each year. And by the time that we actually get to age 67, what you'll see is you're projected to have a portfolio balance of about $6.7 million. So when you're asking us, can we retire and spend $6,000 per month and spend this on travel and do all these other things? Well, we're not asking, can your current portfolio do that? We're saying, can your projected future portfolio do that? So that's step one, is what is that projected portfolio balance? Now, the next thing that we want to do is we want to go to a cash flow summary, where the first several years of retirement, if we actually fast forward to retirement, we want to understand what's your income sources at that time. And by the time they retire, salary has gone to zero, but Social Security has kicked in. And if we look at Social Security, here's Tommy's retirement benefit. And then a couple years later at full retirement age, Linda collects both her benefit and the spousal benefit is the addition to her benefit that then equals half of what Tommy's benefit based on his earnings record would be. So here's their projected income flows every single year, and we compare that to their expenses. So their expenses are the basic living expenses, which are $6,000 per month or $72,000 per year in today's dollars. But if we inflate that by inflation over the next 13 years, it's really closer to $105,000 and growing that we need to plan for. Then on top of that, they have healthcare. So again, healthcare is going to be the Medicare Part B and Part D premiums that we're planning for, plus an additional out-of-pocket expense for both of them. And we're actually inflating these expenses at a rate higher than general inflation. In this plan, we're assuming about a 5% increase on those expenses. And then goals. So they want to be able to spend basic money, so the $6,000 per month, plus healthcare, plus have the $15,000 extra per year to travel. But again, we're going to inflate that because that $15,000 is in today's dollars. So they want another $22,000 per year on top of that. And that's not forever, but that was for the first 15 years or so of retirement. So when we start to add all these up, their basic expenses, plus goals of travel, plus projected tax payments. So in order to net these amounts, how much we have to pay in taxes first, we get total outflows. So total outflows, think of that as total expenses. Where I'd say, Tommy, Linda, I expect that first year of retirement to cost about $215,000. Of course, things are going to change between now and then, and that's why we continue to plan, but as of now, this is a fair place to start. Of that, $44,000 is projected to be covered by your Social Security benefit, which means the remainder, $142,000 per year, that needs to come from your portfolio. Now, not just year 1, but year 2, year 3, year 4, year 5, we really project this all the way out. What we want to know next is this number sustainable? Well, keep in mind, we already projected out their portfolio balance. They're projected to have about $6.7 million right here. So what does that represent as a withdrawal rate? Well, that's where we come to this part of the plan right here. We come to this part and say, yes, you're withdrawing a healthy amount from your portfolio, year 1, but you also have a pretty significant portfolio balance at this point. So if we compare those two things, you're taking out about 2% per year of your portfolio for those first couple years, then that drops because at this point now Linda's Social Security benefit also kicks in. And because more income is coming from her Social Security, less needs to come from the portfolio to maintain the same standard of living. So your portfolio withdrawal rate drops down into the 1.5% range for a while, and it's not until required distributions pick up that that number even increases above 2% again. So as we start to look at that, we say, let's look at your plan high level. Here's where you are today with your current portfolio assets, excluding home, but just cash, savings, and portfolio. You're projected to continue saving and growing and saving and growing, and you retire right here with $6.7 million. And then look what happens. Your portfolio balance keeps growing because you have more than enough money in your portfolio to fully sustain your income needs and still have a significant amount left over to reinvest again and again and again, all the way to the point that you're projected to pass away with about $21 million left in your portfolio. Now, Tommy and Linda have been conditioned to save and to invest and to defer, and it was just really ingrained inside of them. So you look at this, and to them, this was a sign of success of, wow, we're really on the right track. All that hard work and that sacrifice is really paying off. And on the one hand, I commended them. I said, yes, you've been diligent savers. You've been frugal. You've had a healthy income, but you've prioritized saving and planning for the future. But on the other hand, this to me doesn't necessarily represent success. Yes, we want to have a balance at the end. We need some margin, we need some buffer, but this is $21 million, in my opinion, of experiences you could have had along the way, of fun things you could have done with family, of giving you could have done along the way. Do we really want to wait until you're passed away for this $21 million to be used for the good that you want it to be used for? Now I'm going to go back to something I said earlier. One of the kind of offhanded things that they shared with me in our initial meeting was, we wish we had more time to spend with kids today. Work is stressful for Tommy. He loves his work, but work is demanding and there are a lot of hours. But on top of that, even when he does have free time, we feel like we just don't have the cash flow available to do some of the fun family trips we'd like to do. Because yeah, we have a healthy income, but between paying for the mortgage, between saving 24% of it for retirement, between taxes, between other expenses, there just seems to be very little left over to do the fun things we dream of doing. So here's what I said to them. I said, Tommy and Linda, here's my feedback. You should stop saving for retirement. And there was a pause. They just kind of stared blankly at me, stared blankly at each other, and then looked back almost as if they didn't hear me the first time. I said, yeah, I encourage you to stop saving for retirement. In fact, let me show you what that looks like. We came down here to their plan, and I said, let's just assume you stop saving to your Roth IRA. You know what, let's get the match on the 401k because that's free money. We don't want to pass that up. But if you save $8,000 to your 401k, you'll get the full match. So instead of saving $30,000 to the 401k, let's drop that down to $8,000 and let's just stop doing the Roth altogether. Now, in reality, we would just take money from their trust account every single year and shift that into their Roth. So they're still technically contributing, but it's not new dollars. It's just shifting money that they already have. So I said, we're going to drastically reduce how much you're saving here for retirement. In fact, it's $37,000 that you're going to stop saving for retirement. What does that look like? Well, when we rerun the projections, yeah, that has a pretty significant impact. There's $4 million fewer dollars they would have at age 90 in this case. But look at this. Their proposed plan, they're still more than on track to be able to meet all of their needs. So here's what I said to them. I said, take that extra $37,000 that you're no longer saving for retirement and dream up the absolute best family vacations you can take. Your oldest is a sophomore in high school and your youngest is 10. These are some of the years that you're just not going to get back. In fact, I pointed out to them, I said, look, when you're 90 years old right here, are you going to be bummed that there's $4 million fewer dollars in your portfolio and now you only have $17 million? Or how grateful are you going to be instead that you took that money and you enjoyed it when your kids were at home, when your kids were at a great age, and when you had both your time, your health, your energy, and the finances available to do the things that were most special to you. So we dove a bit deeper. My final analysis was simply this, was Tommy, take all the PTO that you can. I know you love your job. Now, if you wanted to, you've got enough money in your portfolio assets that you could retire before 67. But his work truly was meaningful to him, and he had no desire to retire early, but he did want more balance. So his yes continued to work because that's a meaningful part of your life, but take the PTO that you can. Don't necessarily volunteer to be on those extra projects and those extra boards. Take the time that you have with your family, and on top of that, stop saving everything you can towards retirement. You are already on track to be able to meet all your retirement needs, so let's still get the match because that's free money, but let's not save anything additional above and beyond that. Now, as we're going through this is a classic case of when does it make sense to stop saving for retirement? Well, there's two principles that I want to extract here that I think are applicable to anyone. So you, of course, might not be exactly in Tommy and Linda's position, but what two principles can you apply to your situation? Well, the first is the principle of compounding. What does that mean? Well, take a look at this here again. When we look at Tommy and Linda's portfolio, here's their beginning balance. They're saving really aggressively. So they're taking almost a quarter of all their income, all their gross income, and putting it into retirement. Now, when they first began their retirement journey, that's a lot of money. If you're going from zero to $45,000 like they were saving, maybe the market returns 10% in that year, that's a $4,500 return. So at the end of the year, you have $49,500, 45,000 of that was your contributions, and 4,500 was market growth. So when you look at where you are at the end of the year versus the beginning of the year, it's your effort that's getting you most of the way there. But now take a look at this again. They have a portfolio balance this year of about $1.8, $1.9 million. They're still saving aggressively. That $45,000 is taking a toll because that's a lot of their income. Well, the portfolio return is more than 300% of their own contributions. Yes, I know that's not guaranteed. Some years it's going to be higher, some years it's going to be lower, but the general principle is the compounding interest effect is just this. The longer you save, the more your balance, at some point, your growth on your portfolio is significantly higher than your new contributions to it. Let's look at the final year before retirement. Assuming they still get this rate of return of about 8%, they're contributing about $55,000, but their portfolio is growing by almost $500,000 on its own. So the first principle I want to show here is just the principle of compounding. If you're asking yourself, is it time to stop saving for retirement? Well, this is one thing to look at. Does your portfolio really need you at this point? Or can your portfolio, assuming it's invested the right way and assuming we have normal market environments, can your portfolio do a lot of the legwork on its own? Because at the end of the day, the more work your portfolio is doing, the less work that you have to be doing on your end. The second principle here is opportunity cost. So there's an opportunity cost we think about typically in a financial way of what's the opportunity cost of not investing these dollars. And for Tommy and Linda, that was one of the first things they looked at of, geez, James, if we stop saving for retirement, how many dollars are we potentially missing? Well, here's the real opportunity cost for them. Sacrificing these years when their kids are 10, 13, and 16, just so that at the end of their life, they have a few million extra dollars in their bank account. They're not consciously thinking that way, but if it's not for the planning and if it's not for the intentionality of looking at this, that is in fact what they are doing. So the opportunity cost here is if you do continue to save for retirement, what are we missing on the personal side? What trips could we have taken? What giving could we have done now instead of waiting until we pass? What fun activities could we enjoy more of? So when you start thinking in those terms, at some point there does come a time where it may be time to stop saving for retirement. Number one, ask yourself, does my portfolio really need my new contributions, or can it kind of take over from here, just with expected growth in the future? And number two, what opportunity cost am I missing by continuing to save for retirement when I could have been using those dollars elsewhere? When I could have been using those dollars to create experiences or memories that I might never get another chance to make if I don't take advantage of them now. And hey, real quick, if you're enjoying this case study video where we go through a specific client example and extract some principles that you can apply to your situation, make sure you subscribe to this video and give it a thumbs up so you can be notified anytime new videos come out. But as you're looking at your situation, understand that what's ingrained in so many of us is save and defer and invest and push out these things that we think we need to do towards the future. But at some point, there comes a cost to doing that. So instead of just deferring everything for retirement, how can we start to think in a more intentional way, where we can both plan for the future and prepare for the future, but also enjoy life today and create those memories and those experiences today that we may not get another chance to create further down in our future. So the bottom line here is don't let retirement be the all-consuming goal. Let a more aligned life be the goal. And again, that includes both planning for the future, but also fully enjoying today. Now you may be watching this and wondering, well, at what point do I know if I have enough to retire? This is great, James, but you have this software in front of you and these assumptions in front of you. How can I tell if I'm in a position to retire? Well, I'm going to include a video in the end screen where I answer the question, how do I know if I have enough to retire? So check out that video after this is wrapped up to learn whether or not you're in a position where you can stop saving for your retirement goals. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.